Today you have seen a very welcomed rally here in the S&P 500, the Nasdaq, and virtually all asset classes. It comes down to two very important things. One of those were announced about half an hour after trading closed yesterday, and the other one did come about half an hour into trading today. Both of these events fed into each other to give us an over 3.14% rally in the S&P and over a 3.5% rally in the Nasdaq here today. Now, I do want to talk about where I expect the markets to go over the next coming week or two, really what we have as far as data and why the data is going to be so important for our markets and what happens on a day-to-day basis. But I also want to talk about the next Fed meeting and why that could potentially mean newer lows for the markets and where we could end up settling out at to find a bottom for 2022. So we have a lot to unpack here in this video. Hit the like button and subscribe to the channel if you guys find value out of the video. Nonetheless, thank you guys for tuning in, and let's get into it. So the first thing that caused this pre-market gap up, as you guys can see right here, S&P going from about 377 gapped up to about 381 to start off the trading day, was due to this. The Fed bank stress test. The Fed tested 33 financial institutions, and all of them passed their annual stress test of capital reserves. The Fed estimated $612 billion in potential losses for banks in its most severe economic scenario, and said even if this comes to pass, banks would still be healthy enough to provide loans to homes and businesses to keep the economy afloat. That's a $50 billion more severe loss projection than a year ago by the large banks. Now, it goes on to say that what they were actually tested on was a 10% unemployment rate, 55% stock price drop in their annual stress test, but on top of that, a 40% decline in commercial real estate prices and over $100 billion of losses for their trading counterparties. So this basically showed markets that banks can withstand anything that the markets want to throw at it. 10% unemployment, not great at all. 55% stock price drop, not great at all. Losing $100 billion due to trading counterparties such as hedge funds, also not great at all. But the banks would still be in a well-capital position to lend out money and to sustain their business operations. So that was a positive thing, and the markets took that as a positive thing, which they should have. On top of that, what came out today was even more bullish. The Consumer Sentiment Survey, followed by the Fed, shows inflation expectations eased slightly. And inflation expectations are very important because what people expect inflation to be is usually how businesses try to plan to raise prices. Usually businesses don't just wake up one day and they're like, yeah, I'm gonna raise prices 10%. That's not how it works. They say, hey, people expect high inflation, they expect prices to go up, so I'm gonna go ahead and raise prices by this month, right? So on and so forth. Now, the Michigan survey of consumers said consumers expect inflation to rise at a 5.3% annualized rate as of the end of June. So 5.3% is much better than 8.6%. And that's why the markets are liking this information. At the same time, the survey of consumers director Joanne Hishu said consumers, quote, also expressed the highest level of uncertainty over long-run inflation since 1991, continuing a sharp increase that began in 2021. And that, you could really boil that down to people hearing about inflation, right? Not everyone is in the stock market world. Not everyone cares about their financial future. But when people hear about inflation, well, they like to think inflation is going to go higher, right? If you hear about inflation on the news, you don't know anything else, that's kind of what you just stick with, and that's what you expect. So I'm interested in who is actually taking these surveys. I think that would give us a little bit more context to go off of. And now, if we take a look at the next upcoming week, because this market is really categorized by data that we get. If we get really bad data, well, that changes the expectations for how the Fed is going to raise rates, and that changes how the markets are basically looking at the markets. Rates go higher, obviously not a good thing for a vast majority of the stock market. And if high inflation comes out like we seen on a Friday just a couple weeks ago, by that next following Monday, While the markets could price in a more aggressive rate hike, and then 2 days later, that's what the Fed ultimately did. You had the expectations for a 75 basis point rate hike that Friday when that CPI report came out at 3% odds. By Monday, it was at a 97% odds, and then that's what the Fed ultimately did. So if we get more bad data, well, bad inflation data, PMI, CPI, PCE, you're going to see the Fed raising rates more aggressively. And right now, we're expecting an 81.4% chance of a 50 basis point rate hike. Now, where the problem actually comes in and where I think the markets will ultimately flush out to new lows and actually hit a bottom is when we go into a recession and when the markets realize inflation is too high, the Fed will continue to tighten monetary policy. That's when the markets will freak out and overshoot to the downside, and all of this margin debt will compound into massive margin calls across the markets. That's when you will see the mass capitulation and even the fears about a depression. People are talking about recessions right now, but when you start to see financial media talking about a depression based off of what I just said, that's when you could expect to see a bottom. Now, over the next coming weeks, we have the next Fed meeting that comes out July 27th, 2022. That is 4 weeks, 4 days, 21 hours, and 48 minutes away. That comes out 2 p.m. July 27th. Well, on July 28th, that is the first day that we could technically go into a recession. July 28th, you get advanced estimates for Q2 GDP. And if the Fed is raising rates the day before, you go into a recession the day after the Fed raises rates, that's where you're going to get a totally different shift for the market psychology, and that's when I think you could see some big, massive red days. But over the next coming weeks, and specifically over the next week, on Monday, you do have durable goods orders month over month. That could be very important. 7:30 in the morning that comes out. On Tuesday, you do have some wholesale inventories, retail inventories. That is very important as well, because inventories, you've seen a lot of deals at places like Target. People are trying to clear out inventories. When that happens, people tend to lower prices, and that could actually help with inflationary pressures. But at the same time, that's not a good sign for the consumer and for individual businesses. Now, on Wednesday, you don't really have anything too crazy, a lot of oil data that comes out. But on Thursday, you do have personal income month over month for May, and then personal spending month over month as well. And these are expected to be high volatility catalyst events. And that's exactly how I'm going to treat them. Any kind of data that involves the consumer will be very important. You also have PCE price index, initial jobless claims, and a couple bond auctions. And that's basically it for Thursday. On Friday, you do have the ISM manufacturing PMI. So that is going to be one of, if not the biggest catalyst for this week. Thursday and Friday, those are going to be the main days. But until then, I do think you can continue to see a bounce from the bottom. I estimated in between 5 and 10%. But even given the move that we are seeing and given how much we've rallied from the bottom, you could actually rally more than that. So this could be a shorter term bottom, in my personal opinion. Since the bottom at 362 on the S&P, you have effectively rallied about 7.5%, currently sitting at $389.94 on the S&P 500. So you are definitely over that 5% range, in between the 5 and 10% level that I was talking about. If you get that that 10% level, then you could probably make your way up to this moving average, which is the 50-day moving average, and that would put us up about 11.37%. So I do think it's possible we rally above 10% and then ultimately come down to hit lower lows around July 27th, July 28th, and the following days and weeks after that. I think could be pretty bloody until the Fed does ultimately U-turn in some form or the other, and they say, hey guys, we just got bad data, we're gonna slow down just a little bit. That's when the markets could find a bottom and start to slowly retrace back to the upside. But why I think we could actually overshoot in a substantial way to the downside If you guys go ahead and take a look at this Ortex data for the S&P 500 and look at the short interest, it is still very, very high given even this rally that we have seen from the bottom so far. If you look at the short interest on the S&P, currently sitting at 18.86%. This is a level that you have not seen in all of 2022 so far. So even after all of this, you're still very, very pessimistic over the entire stock market, and you have seen some of the most aggressive shorting in the past couple of years. Over the past week or so, there has been a lot of shorting. Now, that's not just it. If you look at the margin debt has went down about $76 billion since the start of the year. And that's only about a 15% drop in overall margin debt, whereas the NASDAQ was down over 30% at the lowest level, still down about 27% currently right now. So if you get another 5 to 10% move down in the NASDAQ, you're going to see hedge funds going bankrupt. You're going to see other businesses going bankrupt. You're going to see margin calls on a level that you guys have not seen in a very long time, even given what has happened in crypto over the last couple of weeks. That situation, there's a lot of dirt under the surface there, and when some of that comes to light, it's not going to be such a good thing at all. So those are really, the things that I am looking forward to. I do think the bottom will be after July 28th, in between probably July 28th and August 15th. That's probably where you're going to see the most pain until the Fed does come out and U-turn in some way or the other. But I think we are in for a decent move from the bottom back up to the top. And the best way I think personally you could protect your portfolios is just riding out this uptrend and then shorting the markets, buying puts when the markets do start to get back up to these levels in between really 405 and 415 on the S&P. That's the sweet spot I want to look at to buy more puts, and that's where you're going to make the most money playing the potential downside late July. So that is pretty much going to be all for this video. Hit that like button if you guys found value out of it. Subscribe to the channel if you guys are new here. Thank you guys for tuning in. Enjoy the rest of your day, and I will see you in the next one.